Imagine you're standing inside a building so large you can't see the top. Cities stacked on top of cities, markets above markets, pensions, savings, salaries, all resting on floors you've never visited. You don't question it. Why would you? It's been standing your entire life, stable, silent, unshakable. Now imagine this. One morning you feel a vibration, not violent, not dramatic, just wrong. A low, dull tremor running through the walls. At first, no one reacts because nothing is supposed to move. Then the sound comes. A deep crack, somewhere far below you. You look around. People pause, screens flicker, numbers start to shift, just slightly. And then someone says it. It's coming from the foundation. Not New York, not London, not the usual suspects. Japan. The place everyone stopped worrying about years ago, the quiet giant, the most predictable market on earth. The one thing in finance that never surprised anyone, until now. Because what's breaking isn't a company, it isn't a bank, it's a bond market so large, so deeply embedded in the system, that most people don't even know it exists. And when something that size starts to move, it doesn't just fall, it pulls. Slowly, quietly, then all at once. And here's the part that should make you uncomfortable. This isn't a crisis happening somewhere else. This is the kind of shift that reaches into your mortgage rate, your job market, your currency, without asking for permission. The foundation is moving, and most people are still looking at the ceiling. Let me be clear. This is not a story about Japan. Japan is just where the crack became visible. This story is about something much bigger. For the last 30 years, the global economy has been running on a quiet assumption. That money could stay cheap, almost forever. That debt could grow without consequence. That someone, somewhere, would always provide liquidity when things got tight. And for a long time, that someone was Japan. Not loudly, not aggressively, just consistently. While other countries raised rates, cut rates, panicked, reacted, Japan did something stranger. It stepped outside the normal rules of economics and stayed there. Near zero interest rates, then negative rates, then direct control over its own bond market, an entire financial system operating in slow motion, and the rest of the world adapted to it, built on top of it, relied on it. Here's the catch. When you build a system on something artificial, it works perfectly. Until it doesn't. Because the stability you're seeing is not natural. It's engineered, maintained, protected. You can think of it like this. The global economy wasn't standing on solid ground. It was standing on a hidden support beam, one that had been quietly absorbing pressure for decades. Cheap money, endless liquidity, minimal cost of borrowing. And over time, that support beam became invisible. Not because it wasn't important, but because it was always there. Now do the math. What happens when that support starts to weaken? Not collapse, not explode, just loosen. Suddenly, everything that depended on it has to adjust. Asset prices, currencies, debt markets, even the idea of what safe means. This is what we're really looking at. Not a crisis, a transition. From a world where money was artificially cheap to a world where it isn't. And transitions like that are never smooth. Because when the price of money changes, everything gets repriced, including risk, including power, and eventually, including you. To understand what's happening now, you have to go back to a moment when Japan quietly did something no one else dared to do. It broke the rules. In the late 1980s, Japan looked unstoppable. Real estate prices were exploding, stocks were soaring. At one point, the land under the Imperial Palace in Tokyo was said to be worth more than all the land in California. It didn't make sense, and eventually, it stopped making sense for everyone at the same time. The bubble burst violently, Asset prices collapsed. Companies were left with debts they couldn't repay. Banks were sitting on loans that no longer existed, at least not in any real recoverable form. And then something worse happened. People stopped spending. Not because they couldn't, but because they didn't want to. Prices were falling. So why buy today, when it might be cheaper tomorrow? It sounds rational. It's actually lethal for an economy. Because when people stop spending, companies stop earning. When companies stop earning, they stop hiring. And when that happens, everyone spends even less. A slow, quiet spiral. No explosion, just a steady descent. So Japan tried something radical. In 1999, it cut interest rates to zero. Not low. Zero. And when that wasn't enough, it went further. Negative rates. Which is exactly what it sounds like. You don't earn interest for saving money. You get penalized for it. The message was simple. Spend. Invest. Do something. Because if you don't, we will make sure holding cash hurts. Let me be clear, this wasn't innovation, it was desperation. Japan had run out of traditional options, so it stepped into a space no major economy had lived in before. And then something strange happened. It stayed there, not for a year, not for a crisis cycle, for decades, through the 2008 financial crisis, through the European debt crisis, through COVID. While the rest of the world moved up and down, Japan stayed pinned near zero. An economy frozen in place, held together by one idea. Make money as cheap as possible and hope the system restarts. But here's the unintended consequence. When money becomes almost free, it doesn't just stay inside the country, it starts to move. And when it moves, it changes everything. Now imagine you're an investor. Doesn't matter where you are, New York, London, Singapore, you're not emotional, you're not patriotic. You're looking for one thing: return. And suddenly, Japan offers you something unusual. You can borrow money there at almost zero cost. Not cheap, almost free. So you do the simplest calculation in finance. You borrow in Japan, you convert that money into dollars, and you invest it somewhere that actually pays you. US bonds, European assets, real estate, stocks. Anywhere with yield. If Japan gives you money at close to 0% and you earn 4% somewhere else, that gap is yours. Clean, simple, repeatable. Now scale that up. Not just one investor, thousands. Then institutions, banks, hedge funds, pension funds, entire financial systems running the same play. This strategy even has a name, the carry trade, but the name is too soft for what it became. Because this wasn't just a strategy. It was a global engine. Trillions of dollars moving across borders, chasing that gap. Year after year, quietly, predictably. You can think of Japan as something very specific, not a country, a funding source, a massive reservoir of cheap capital feeding the rest of the world. And once that system is in place, everything adapts to it. Governments get used to cheap buyers of their debt. Markets get used to abundant liquidity. Investors get used to easy returns. It becomes normal, expected, even necessary. Here's the catch. This entire system depends on one fragile assumption: that borrowing in Japan stays cheap and stable forever. Because the moment that changes, the math stops working. And when the math stops working, the money doesn't just slow down, it reverses. And reversals, in systems this large, don't happen gently. At this point, something subtle happened. The world didn't just use Japan's cheap money, it got used to it. Then it depended on it. Then it couldn't function without it. Because once trillions of dollars start flowing through a system, they don't just disappear without consequences, they shape everything. Think about it. If governments know there will always be buyers for their debt, they borrow more. If investors know liquidity is everywhere, they take more risk. If markets are constantly being fed, they stop asking where the food comes from. It becomes normal, even logical. Stock markets rise. Real estate inflates. Emerging economies attract capital they wouldn't normally see. And underneath all of it, the same mechanism keeps running. Cheap yen flowing outward, over and over again. You can picture it like this. A room filled with oxygen, invisible, essential, constant. No one talks about it because it's always there, but remove it, and suddenly everything changes. That's what Japan's policy became. Not a tool, an environment, a condition the entire global system adapted to. And here's where it gets uncomfortable. Because once a system adapts to something artificial, it loses the ability to function without it. This is where we are. A global financial system built on cheap money that was never meant to be permanent, but became permanent anyway. And when something like that starts to shift, it doesn't create a small adjustment. It creates stress everywhere, because all those gains, all that growth, all that stability was never entirely organic. Part of it was borrowed. And now, that borrowed support is starting to move. Now imagine you're Japan's central bank. You've kept interest rates near zero for years. You've flooded the system with liquidity. And still, the economy refuses to behave. Growth is weak. Inflation is low. Confidence is fragile. So you take it one step further. You stop letting the market decide. Instead, you decide for the market. This is where Japan introduced something called yield curve control. But don't let the name fool you. What it really means is simple. We will not allow interest rates to rise at all. If investors try to push yields higher, the central bank steps in and buys bonds, as many as needed. No limit, no hesitation, just control. And over time, this changes the nature of the market itself. Because a market only works when prices are discovered, when buyers and sellers negotiate freely, when risk is priced honestly. But here, none of that was happening. Prices were managed, yields were capped, volatility was suppressed. The system looked calm because it was being held down. The Bank of Japan ended up owning a massive share of its own bond market. Think about that for a second. The largest buyer was the same entity setting the rules. At that point, this isn't really a market anymore. It's a mechanism, a controlled environment, a kind of financial greenhouse where nothing is allowed to grow too fast or die too suddenly. And for years, it worked. Yields stayed low, debt stayed manageable, volatility stayed contained. From the outside, it looked like stability, but it wasn't. It was pressure being compressed, held in place. Because here's the problem with controlling a market for too long. You don't remove risk, you delay it, you concentrate it, you make sure that when it finally moves, it moves all at once. And that's exactly what started to happen. The moment Japan began stepping back, even slightly, the market had to relearn something it hadn't done in decades. Move freely. And when something that size wakes up after being held still for that long, it doesn't stretch. It snaps. For years, Japan held the line. No matter what the world was doing, no matter how inflation moved, no matter how markets behaved, Japan stayed in its own lane. Ultra-low rates, heavy intervention, full control, and then, quietly, that started to change. Not dramatically, not aggressively, just enough to matter. The Bank of Japan began stepping back. It ended negative interest rates. It loosened its grip on the bond market. It signaled that things might normalize. On paper, this looked harmless. A small adjustment, a cautious exit. But in reality, it was something else entirely. Because when a system has been artificially stabilized for decades, you don't get to gently return to normal. There is no smooth transition. There is only repricing. And repricing is where things get uncomfortable, because suddenly, investors have to ask real questions again. What is the true cost of borrowing? What is the real risk of holding government debt? What happens if the central bank isn't there every time? These are questions the Japanese bond market hadn't needed to answer for a very long time. And once those questions come back, so does uncertainty. Let me put it simply. For decades, Japan was suppressing gravity. Now it was slowly turning it back on. And the moment you do that, everything that was floating has to find where it actually belongs. Some assets adjust quietly, others don't. Because here's the thing. Markets don't fear change, they fear uncertainty. And Japan had just introduced it into the one place that was supposed to be completely predictable. The safest market in the world was no longer safe in the same way. And that alone was enough to make people nervous. But nervous isn't panic. Not yet. For panic, you need a trigger. And then, the trigger arrived. Not from the central bank, from politics. Because fragile systems don't usually break on their own. They get pushed. A new leadership comes in. New priorities, new promises, more spending, tax cuts, support for households. On the surface, it sounds familiar, even reasonable. But here's the problem. Japan was already one of the most indebted countries in the developed world. So when markets heard more spending, they didn't hear growth. They heard one word, debt. And debt in a bond market is not theoretical, it's supply. More spending means more borrowing. More borrowing means more bonds. More bonds means more pressure on prices. Now combine that with a central bank that is no longer fully controlling the market. And suddenly, investors have to step in. Real buyers, real demand. And for the first time in years, they hesitate. Bond auctions start to weaken. Demand isn't what it used to be. Confidence begins to wobble. And this is where the psychology shifts. Because bond markets run on one thing above all else. Trust. Trust that the government can repay. Trust that inflation won't erode returns. Trust that someone else will buy after you. When that trust cracks, even slightly, everything changes. Investors don't wait to be proven wrong. They move first, they sell, and when enough of them do that at the same time, you don't get a slow adjustment. You get a signal, a very loud one. The kind that says, this is no longer stable. And once that signal is sent, it spreads. Fast. Because in financial markets, fear doesn't need permission, it just needs a starting point. And then, it happened. The moment markets stop pretending everything is fine, it starts quietly. A weak auction, a few hesitant buyers, yields ticking up just a little faster than usual. Then something shifts. Investors stop asking, what's the return? And start asking, what's the risk? And that's the line you don't want to cross, because once a bond market becomes about risk, instead of certainty, you're already in trouble. Selling begins, not coordinated, not planned, just rational. If yields are rising, prices are falling. And if prices are falling, you don't wait, you exit. Now scale that behavior across banks, funds, insurance companies, everyone holding the same asset, everyone watching the same screen, everyone thinking the same thing. I should probably get out. This is what markets call a sell-off, but that word is too calm for what it really is, because this isn't just selling, it's a loss of confidence. And confidence, once it breaks, doesn't come back quickly. Yields surge across the curve. Short-term, long-term, everything moves. And here's the dangerous part. Higher yields don't fix the problem, they amplify it. Because when yields rise, the government's borrowing cost rises, which makes the debt look riskier, which pushes yields even higher. A loop. Tightening, accelerating, feeding on itself. This is the moment the system flips, from stable to unstable, from controlled to reactive. You can think of it like this. For decades, the market was being held underwater. Now it's been released, and instead of floating calmly to the surface, it shoots up, violently, unpredictably. This is the Bond Revolt, not a crash, a refusal, a collective decision by investors to stop playing by the old rules. And when that happens, it doesn't stay contained. Because Japan doesn't exist in isolation. It never did. For decades, Japanese capital has been everywhere. Inside US bonds, European debt, global equities, quietly embedded in the financial system. So when something breaks in Japan, it doesn't stay in Japan, it travels. Here's how. The same investors who once took money out of Japan now start bringing it back. Why? Because suddenly, Japan is offering something it hasn't offered in a long time. Return. Real return, in its own currency, with less uncertainty. So the logic flips. Instead of sending money abroad, they repatriate it. They sell foreign assets, convert currencies, move capital home. Now pause for a second. Who are these investors? Not small players. We're talking about some of the largest holders of global debt, including US treasuries. So when they start selling, it matters. A lot. Because bond markets are sensitive to supply. More selling means lower prices. Lower prices mean higher yields. And suddenly, the shock spreads. US yields rise, European yields follow, global borrowing costs increase. Not because those economies changed, but because capital moved. This is the part most people miss. Crises don't always spread through headlines. They spread through flows. Invisible, mechanical, unavoidable. Money leaving one place has to go somewhere else. And when those movements are large enough, they reshape entire markets. At the same time, equities begin to feel the pressure because higher bond yields make stocks less attractive. Risk gets repriced. Liquidity tightens, and markets that were floating on cheap money start to feel heavier. This is no longer a local event. It's a transmission from one system into all the others connected to it. And in a globalized financial world, that means almost everything. Because once the flow reverses, you don't just lose momentum, you lose support. And when support disappears, markets don't ask questions, they adjust. Now we get to the part no one sees, but everyone feels. Because the real damage isn't happening on the surface, it's happening inside positions. Inside trades that were never meant to be unwound quickly. Remember the system. Borrow in yen, invest somewhere else, collect the difference. Simple. Until one variable changes. The currency. Because this entire machine depends on one fragile condition. The yen must stay weak, or at least stable. If it rises sharply, everything breaks. And that's exactly what starts to happen. As capital flows back into Japan, demand for yen increases, the currency strengthens, and suddenly, those safe trades aren't safe anymore. Because now, you don't just have to repay your loan, you have to repay it in a stronger currency. Which means you owe more than you expected. That small interest advantage, gone. Reversed. Now do the math. If you're sitting on billions in positions, you don't wait to see how bad it gets. You close, fast. You sell the assets you bought. You convert back into yen. You repay the loan. And when thousands of investors do this at the same time, you don't get a correction. You get an unwind, a forced one, across multiple markets, stocks, bonds, real estate, anything that was funded with cheap yen. Everything gets sold. Not because it's bad, because it's leveraged. This is the hidden explosion. No headlines, no central event, just positions collapsing, one after another, like a chain reaction. You can picture it like pulling a thread out of a tightly woven fabric. At first, Nothing. Then suddenly, the structure starts to unravel, and once that process begins, it doesn't stop on its own, because the system isn't designed for reversal. It was built for continuation. Cheap in, returns out. Now that flow is reversing, and reversals in leveraged systems are never smooth. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. Now here's where things get interesting, because normally, in times of global stress, the dollar strengthens. It's the default reaction. Money runs to safety. And for decades, that meant the US. But this time, something different happens. The dollar doesn't surge, it gets hit. From multiple directions at once. Let's break it down. First, when Japanese investors sell US assets, they don't keep the dollars, they convert them back into yen, which means selling pressure on the dollar and demand for the yen. Second, for years, the dollar had a clear advantage, higher yields. You could earn more holding US assets than Japanese ones. That gap made the dollar attractive. Now that gap is shrinking. Japan is offering higher yields, not equal, but close enough. And when the difference narrows, the incentive disappears. Third, confidence. And this one is subtle but powerful. At the same time, this is happening. Global investors are already questioning stability. Trade tensions, tariffs, political unpredictability. And suddenly, the idea that the US is the unquestioned safe haven doesn't feel as solid as it used to. Put all that together, and you get something rare. A currency under pressure during a global shock. You can think of it like this. The dollar isn't collapsing, but it's being squeezed. From three sides at once: capital outflows, shrinking yield advantage, rising uncertainty, a tightening triangle. And when a currency gets squeezed like that, it doesn't need a crisis to fall. It just needs time. Now here's the consequence. When the dollar weakens, the entire global system shifts, because the dollar isn't just a currency. It's the pricing mechanism for trade, for debt, for commodities. So when it moves, everything moves with it. And that brings us to the asset that reacts the fastest when trust starts to fade. And when trust starts to fade, money looks for somewhere to hide. Not somewhere productive, not somewhere innovative, somewhere neutral. This is where gold comes in. Not because it's exciting, not because it generates income, but because it doesn't depend on anyone's promise. No government, no central bank, no balance sheet. Just value that isn't owed by someone else. And in moments like this, that becomes very attractive. Think about what's happening. Bond markets are unstable, currencies are shifting, interest rates are rising. Unpredictably, the entire system starts to feel conditional. If this holds, if that stabilizes, if nothing else breaks, gold doesn't care about any of that. It doesn't need conditions. It doesn't need confidence in policy. It only needs one thing: doubt. And right now, there's plenty of it. So capital starts to move, not all at once, but steadily. From assets that depend on trust into something that doesn't. And here's the key point. Gold isn't rising because something good is happening. It's rising because something fundamental is weakening. Confidence in debt, in currencies, in the idea that the system is fully under control. You can think of gold as a kind of mirror. It reflects what people are starting to feel before they fully understand it. And what it's reflecting right now is uncertainty. Because when the price of money becomes unstable, people stop asking how to grow it. They start asking how to protect it. And protection always comes before opportunity. This is gold's moment, not as a winner, but as a fallback. A signal that the system is no longer fully trusted. And when that signal appears, it usually means one thing. We're entering a different kind of environment. One where stability is no longer assumed. It has to be earned. Now let's bring this back to you. Because it's easy to listen to all of this and think it's happening somewhere else. Bond markets, currencies, central banks, abstract things, distant things, but they're not. They're upstream, and you are downstream. Which means whatever happens there eventually arrives here, just in a different form. Let's make it simple. When bond yields rise, borrowing becomes more expensive, not just for governments, for everyone. Your mortgage, your car loan, your business financing, all of it is priced off those same markets. So when Japan's bond crisis pushes global yields higher, you feel it, not as a headline, as a higher monthly payment. Now, take a small business owner. He used to borrow cheaply to expand, hire more people, buy equipment, take risks. Now the cost of that loan is higher, so he waits, he delays. Maybe he cancels the plan entirely. Multiply that decision across thousands of businesses, and suddenly, growth slows, hiring slows, opportunities shrink. Now look at markets. When bonds offer higher returns, investors shift. Why take risk in stocks when you can earn a safer return elsewhere? So capital moves, stocks lose support, valuations come down, and if you have savings invested, you see it directly. Then there's inflation, because when companies face higher borrowing costs, they don't absorb it. They pass it on, into prices, into services, into everything you buy. And just like that, your cost of living rises. Not because of one decision, but because of a chain reaction that started somewhere far away. This is how financial systems work. They don't ask where you live. They don't care what you invest in. If you're inside the system, you're connected to it. And Japan, whether you realize it or not, has been one of the engines behind it for decades, quietly shaping the cost of money for the entire world. So when that engine starts to misfire, you don't need to be an investor to feel the impact. You just need to exist inside the system, which you do. We all do. And that's why this matters. Because this isn't just a financial story. It's a shift from a world where money was easy to one where it isn't. And that shift has consequences everywhere. So where does this go from here? Not in headlines, not in predictions, but in paths. Because systems like this don't collapse in one direction, they branch. Let's walk through the three that actually matter. Outcome 1. Controlled stabilization. The Bank of Japan steps back in. Not fully, not like before, but enough. Targeted bond buying, verbal reassurance, just enough pressure to calm yields. Markets breathe again, yields stop rising, or at least slow down. Capital flows stabilize, the system holds. But here's the catch, nothing is fixed. The underlying problem doesn't disappear, it's just contained. Again, this is the familiar pattern. Delay the adjustment, buy time, hope conditions improve, and sometimes that works, for a while. Outcome 2. Slow global reset. No panic, no collapse, just a gradual shift. Higher interest rates become the new normal. Liquidity doesn't disappear, it tightens, step by step. Governments pay more to borrow. Investors become more selective. Growth slows. Quietly. This is the least dramatic path, but also the most structural, because it changes behavior. Risk is priced differently. Capital becomes more cautious. Easy gains become harder to find. The world adjusts, not overnight, but permanently. And if you zoom out, this might be the most realistic outcome. Not a crash, a reset. Outcome 3. Cascade failure. This is the one markets fear, but rarely expect in advance. The sell-off continues, yields keep rising, confidence doesn't return, and at some point, something breaks. Not necessarily in Japan, somewhere connected to it, a major institution, a heavily exposed fund, A weak link in the chain, and when that happens, liquidity disappears fast, not gradually, suddenly. Markets freeze, selling accelerates, central banks are forced to react aggressively. This is where interventions return, not as policy, but as emergency. And if it reaches this stage, the system doesn't just adjust, it gets rewritten. These are the paths: containment, reset, or rupture. And the uncomfortable truth is, we don't get to choose which one happens. We only get to watch and react. If there's one thing to take from all of this, it's this. The world wasn't as stable as it looked. It was supported, subsidized, held together by something most people never saw: cheap money. For decades, that cheap money made everything easier. Borrowing, investing, growing. It smoothed out shocks, delayed consequences, made risk feel smaller than it actually was. But it didn't remove the problems. It stored them, compressed them, and now that support is starting to weaken, not disappear, not collapse, just become more expensive. And that changes everything, because when the price of money rises, every decision becomes harder, every risk becomes more visible, every mistake becomes more costly. This isn't the end of the system, it's the end of a version of it. The version built on abundance, on cheap funding, on the assumption that liquidity would always be there. What comes next is a system that has to stand on its own, and systems like that are less forgiving, more selective, more real. If the global economy has been running on artificially cheap money for decades, what happens the moment it has to function without it?